For decades, the US dollar was the world's financial superstar, the currency everyone trusted. But lately, that trust is fading fast. In a dramatic shift, foreign investors have pulled out over $130 billion, signaling a massive vote of no confidence. Countries once hoarded US dollars and treasuries as the safest bet, but now they're noticing cracks in America's financial stability. The dollar's value has plunged, hitting a 3-year low, and the DXY index has dropped over 10%. The world is quietly, but decisively, moving away from the dollar's table. This isn't just a blip, it's a historic shift, one that's sending shockwaves through the world of finance. For decades, the United States has been the bedrock of global stability, its government debt seen as the ultimate safe haven. But now, the numbers are telling a different story, one that's making investors and policymakers alike sit up and take notice. Foreign ownership of U.S. government debt has plummeted from over 50% during the 2008 crisis to just 30% today. That's not just a statistic, it's a dramatic retreat by global investors who once eagerly snapped up U.S. treasuries, trusting in America's economic might and political stability. Now, with fewer countries willing to finance America's spending, the U.S. is being forced to offer higher interest rates to attract buyers. The government must sweeten the deal, making borrowing more expensive for itself, and ultimately, for taxpayers. This shift is reshaping the global financial landscape, as the cost of funding America's ambitions rises. As borrowing costs rise, the government faces even more pressure on its already massive debt. Every uptick in interest rates means billions more in payments, squeezing budgets and forcing tough choices about spending on everything from infrastructure to social programs. Central banks around the world are also rethinking their strategies. No longer content to keep all their eggs in one basket, they're diversifying their reserves, seeking safety and stability in a changing world. The dollar's share of global reserves has dropped from 70% to 57% in just 2 decades, a significant decline that signals a shift in confidence. Other currencies, like the euro and the Chinese yuan, are slowly gaining ground as alternatives. In fact, 70% of central banks now plan to reduce their dollar holdings. This isn't a sudden move, but a carefully considered strategy to protect their nations from potential shocks in the U.S. economy. This isn't panic, it's a calculated retreat, a slow and steady repositioning as the world's financial leaders weigh their options and hedge their bets. The world sees America's political gridlock and ballooning debt as growing risks. Every headline about a government shutdown or a debt-ceiling standoff chips away at the trust that once seemed unshakable. The safe haven is starting to look dangerous. Investors are asking hard questions about the future, and some are quietly moving their money elsewhere just in case. When trust erodes, the world looks for a new place to park its money. The story of numbers and nerves is still unfolding, and the next chapter could reshape the global economy for years to come. So where's the money going? Gold. Central banks, especially in emerging markets, are buying gold at record rates, doubling its share in their reserves from 4% to 9%. Countries like China, Russia, and Turkey are leading the charge, seeking security in something tangible. Gold can't be printed or sanctioned. It's the ultimate hedge against political and financial chaos. This gold rush has sent prices soaring, with forecasts of $4,000 an ounce by 2026. Central banks are also diversifying into currencies like the Australian and Canadian dollars. The world is building a portfolio, not betting everything on the dollar anymore. Why now? 3 reasons: America's exploding debt, political dysfunction, and the weaponization of the dollar. U.S. debt is set to hit 118% of GDP by 2035, a red flag for lenders. Political chaos and government shutdown threats have shattered America's reputation for stability. But the biggest shock came when the U.S. froze Russia's central bank reserves after the Ukraine invasion. That move showed the world that dollar assets can be seized with a pen stroke. Now countries see their dollar holdings as potential liabilities, not just assets. The U.S. revealed the financial kill switch, and the world is scrambling to build alternatives. The dollar's power play has triggered a global search for escape routes. Enter the BRICS bloc: Brazil, Russia, India, China, South Africa, and now a growing list of interested countries. These nations are coming together with a bold mission to reduce their dependence on the U.S. dollar and reshape the global financial landscape. For decades, the dollar has been the world's dominant currency, giving America enormous influence over international trade and finance. But now, these emerging powers are saying, enough. They're building new systems to trade in their own currencies, bypassing the U.S. and its banking system entirely. This means that when a Brazilian company buys goods from India, they can settle the deal in reais and rupees, not dollars. It's a quiet revolution, but one with huge implications for the future of money. China and Russia, for example, now settle much of their trade in yuan and rubles instead of dollars. This shift isn't just symbolic. It's a practical move to insulate themselves from US sanctions and financial pressure. Even Saudi Arabia, long a pillar of the petrodollar system, is now considering selling oil to China in yuan. If this happens, it would be a direct challenge to the dollar's dominance in global energy markets, a move that could ripple across the world economy. To make all this possible, BRICS nations are developing their own payment networks and financial technologies. These systems are designed to operate independently of Western banks, making it harder for the US to use sanctions as a weapon. China's CEPS, for instance, is rapidly expanding. It's a cross-border payment system that aims to rival SWIFT, the backbone of global banking. If successful, it could create a parallel financial universe, one where the dollar is no longer king. As America's share of global GDP shrinks and Asia's economies surge, the world's economic center of gravity is shifting eastward. This isn't just about money, it's about power, influence, and the rules that will shape the 21st century. The rise of BRICS and the push for de-dollarization are natural responses to a changing world order. As new powers emerge, they want a financial system that reflects their interests, not just those of the old guard. The club is open, and the world is watching. If the dollar loses its crown, the US faces a harsh reality. The exorbitant privilege of cheap borrowing disappears, and interest payments on national debt could skyrocket. Painful choices loom: cut spending, raise taxes, or both. American households would feel it too. Higher rates on mortgages, loans, and credit cards. US assets could lose appeal, hurting retirement savings. Globally, a multipolar currency system could mean more volatility and fragmentation. Other countries would gain more monetary independence, but the transition could be messy. The end of dollar dominance would force America and the world to adapt fast. But let's not write the dollar's obituary just yet. While headlines often predict the demise of the US dollar, the reality is far more complex and nuanced. The dollar's story is one of resilience, adaptation, and global influence that has been built up over decades. Despite its troubles, there's no real alternative with the dollar's scale, liquidity, and trust. The euro, for example, is fragmented by the differing economies and policies of its member states, making it difficult to act as a unified global reserve. The Chinese yuan, meanwhile, is tightly controlled by the government, with strict capital controls and limited convertibility. This makes it hard for international investors and governments to fully trust or rely on it as a global currency. Other currencies, like the Japanese yen, British pound, or Swiss franc, are simply too small in scale to challenge the dollar's dominance. No other currency comes close to matching the dollar's reach or influence. The global financial system is deeply wired for dollars. Changing that would be like switching the internet's language overnight. Every major bank, corporation, and government is plugged into this dollar-based network, making any transition slow and complicated. The dollar still dominates global trade, serving as the preferred currency for buying oil, raw materials, and manufactured goods. Most international contracts are still written in dollars, reinforcing its central role. It's also the backbone of international loans and the primary reserve currency held by central banks around the world. Trillions of dollars are exchanged every day, keeping the global economy running. Its incumbency is a powerful shield, giving the US unique advantages and influence over the world's financial system. This status is not easily surrendered, but the trend is clear. The dollar is obetransfer, the dollar dans, and the bans, and G, and dan and jinking, as countries diversify their reserves and seek alternatives. New technologies and shifting alliances are slowly chipping away at its dominance. America's privilege is fading, and the world is watching closely. The dollar's supremacy is no longer guaranteed, and its future will depend on how the US adapts to new global realities. The fall won't be sudden. It'll be a slow, grinding process, marked by incremental changes rather than dramatic collapse. The world's financial order is evolving, not erupting. The world is already building a new financial order, with countries forging new alliances, experimenting with digital currencies, and seeking ways to reduce their dependence on the dollar. The dollar's era of easy dominance is ending, but its legacy and influence will linger for years to come. The next chapter in global finance is just beginning.